Hi. Hello, hello. Hi, Andrea. How are
Hi,
you?
I'm fine. How are you?
I'm good, thank you.
Where did you travel to last? I saw an email where you said I'm on the way to the airport.
Last I traveled to, I had a crazy spring week. I traveled to Mexico City and from there to Montreal. And then I went to see my brother in Ottawa. Hi, Linda. Hi, let me introduce the two of you. I'm not sure whether you have met. Linda Goldberg from the Fed and then Andrea Binder in
Me too.
Berlin.
My
It's the
pleasure,
Otto
Linda.
Suhr. It's the Otto Suhr Institute. No,
Yes.
Andrea?
Yeah.
Okay. Okay. So I just so I will share the session for today. And my thought after reading the materials that you proposed was maybe we start with John Locke and his
Okay.
idea. For England, like 17th century, his idea about monetary policy and how this impacted, international relations. In fact, even England in the war, right? That was kind of shocking. That his I don't know what
But I
maybe
do actually in the presentation, I do make a rather quick move to the present day.
the present as well. Okay. So
And the
we
dollar
can
system.
we can handle it either way. That was just a proposal. I just thought because it might be interesting to start with, early conceptualizations of monetary policy and also how people struggled with the importance or lack of importance of a real, peg or standard. And then we'll shift to today's management of international liquidity with a very different structure. And yet, I think, as Linda suggests in her own writing, there's also a lot of domestic management that has these spillover effects in global setting, where we have some institutional structures now to manage it a little bit, but it really depends on whether you have a swap line or not. So at least that's my reading. Anyways, does that make sense for the two of you? Yeah.
Yeah, that flow works nicely. I'll also give a little bit of history, just on the structure of banking, global banking
Nice.
Oh,
over
that'd be
time.
great. Yeah, that would be great. Yes. Let me just get my lamp here out of the way. It's in my way here. Okay, so people are coming in already. We have a couple of minutes to go, so we start at 12:10. But it's good that we at least have a little chance to talk. Hi, Perry. Good to
Do you
see
want
you.
us to practice to see if we could share our screen?
Yes, let's try that. I think Catherine is in the background. Maybe she can make you a host if you're not already.
Yeah, hi. Yes, I'll make you both hosts so you can share your screen. 1 second. Okay, I think I've made both of you co-hosts, so you can go ahead and try.
Do you want to go first, Andrea?
First and share and open my presentation.
Okay. Yeah, it
Yeah,
shows.
great. Yeah,
Yeah.
Wonderful. Okay. Then I stop sharing.
awesome.
Okay. So Linda, I think you can share now. Yeah. Okay.
Okay. Perfect.
That's great.
Yeah. Just give up this. Okay, I just want to make sure my phone is off.
A very good point, actually.
I haven't seen Matthias yet, but I know he's coming, so we'll just wait. Hi, Waltraud. Good to see you. Thanks for coming.
Yeah. Thanks for giving this talk last week about your new book. Forward to seeing it.
Yeah, I was a little thrown off because I had committed to this talk, and I was always contacted by a student from Iowa, and then people said, "You're coming to the UI," and I said, "I don't know, not that I know of." But then I
The
also
Max
found
Weber Fellows that leak things. Yeah,
yeah.
I
So
can
you
understand.
be in different parts of the world at the same time now, just with
Yeah.
Zoom. Like
Yeah.
feels like you know, these old TV shows where you just make bing and you're somewhere else. You know, the genie or something. Do you remember that?
Yeah, exactly. Plus ça change.
Yeah. Well, now it's real. I mean, that there it seemed to be completely, you know, surreal, and so we
Yeah.
have a
Yeah,
group
so
coming
plus
in.
I need you two audiences. That's right.
Okay. So we will start in a second. I'll just give it another minute or two. If you're not speaking, I ask everyone just to put yourselves on mute so we don't have interruptions, interferences. Thank you very much for that. Okay. Okay. Okay, so it's 12 past. I suggest we get started. People are still coming in, and I'm sure also Matthias will be with us in a second, but I don't want to let our speakers wait too long. So welcome to everyone. Thank you for joining us again today for our seminar series, which is sponsored by the Center for Political Economy at Columbia University, of which I am one of the co-directors, and I also have launched together with Matthias Thiemann from Sciences Po this online seminar series on the political economy of liquidity. Many of you have been here before. I'm really pleased to see repeat players, so thank you for joining us again. Today we have a really exciting session on the political economy of geopolitical, so the geopolitical economy of liquidity management. And we have two excellent speakers to introduce us to these topics. Andrea Binder from the Otto Suhr Institute in Berlin, who has worked extensively on offshore finance, and Linda Goldberg, who is at the Fed in New York and a researcher at the Fed of New York. And she's also spent a lot of time looking at international dollar liquidity and its role in the foreign exchange and international monetary system more broadly. So without further ado, we'll just do the same pattern that we've had before. I give each of the two speakers about 15 to 20 minutes, 20 marks, to present their core thesis, and then I will ask each of them maybe to comment on each other's talk, and we open it up for questions. If you want to place questions in the chat, please do so. I will pick them up, but I will also call on you if you want to articulate your questions yourself. So thank you very much. Andrea Binder, we thought we'd start with Andrea. If you had a chance to look at the readings, she gave us a paper by Stefan Eich, doing the German pronunciation here, on John Locke, and I thought it was interesting maybe to go back to his conceptualization of money and the value of money. Or the so Andrea, take it away, and then we'll continue with Linda later on. Go ahead.
Thank you very much, Katharina. First of all, I try to share my screen again so that you can see my presentation. Now share, so I get the presentation. So I hope you see this now. So thank you very much for having me and
Andrea,
for making.
oh, okay, here we go. Okay.
Is it there? Yeah. Okay. And for making me think through the geopolitical economy of liquidity management. Matthias asked me whether I could come along, and of course I'm very grateful for the invitation, but I already warned him that liquidity management, because I'm looking very much at power, it might be a bit more bigger picture than the mechanisms of global liquidity. He also asked me to pick a piece to share with you for reading that I found influential on my thinking, and this is why I chose Stefan Eich's piece on John Locke's monetary thought, and particularly on the depoliticization of money. So what I will do, I was told it's 20 minutes. I try to maybe be a bit briefer, but maximum 20 minutes, I promise. I do 3 steps. First, I will share a little bit the approach that I take to looking at the geopolitics of global liquidity. Then I will talk a little bit about the offshore dollar. And then in the 3rd step, I want to talk through the geopolitical consequences. So the approach or the idea why I found thinking about John Locke's idea of the depoliticization of money, and then as a counter movement, the question of should we repoliticize money interesting, because I think Stefan in his piece drives home the point very well that denying money's conventionality, and by that he means like that it is based on common convention, obscures the implied political possibilities. And what I find very important about that is that once we deny that, like our room of potential political choices becomes smaller, and we don't even question this kind of room of maneuver anymore. So that was important to me. Then when I read the piece, I must say I was also particularly intrigued by how modern Locke is. So of course it's the modern period, but he's confronted with a financial crisis. In this case, it's like the clipping crisis in the late 17th century. And his response to the crisis is suspended between the naturalization of money and the malleability of it. So what he does, according to Eich's argument, is to link the value of money to an initially arbitrary but then unalterable quality. And I think this is a motif, if you want, so that we can find as well, if you think about like managing monetary stability in the Eurozone, we have the 2% goal. It is initially arbitrary, could be a different percentage number, but then it's actually in the contracts and directs policy very much. So I found that an important thing to remind us. And then lastly, I find it important to think about Locke in terms of how successful as a political project it is to say, if we have financial crisis, we use this tension between an assumption of money as being natural, as following natural laws, right? We also refer to liquidity. Of course, this is very much a language from the sciences, from the natural sciences, or the velocity of money, all this language. And then also use the fact that actually it is very malleable. So these were the 3 points why I thought it is interesting to conceive of Locke from today's perspective. From this suspension between the naturalization of money and its malleability, in crisis situation, I think it is sort of like a very logical step, is that then you always have sort of the counter movement, where you have the argument, actually, we have to repoliticize money, we have to get the political nature of money back out, so that we can open the political opportunities for our response. And so I think, at least like within the scholarly community that I'm in, that this debate was very much around money as a tool to further political goals other than monetary management. So of course, green investment comes to mind, but also in the question of like the political power of central banks and whether we need to democratize central banking, etc. When I talk about the repoliticization, or what I want to try with the presentation, is to argue that actually there's another way of politicizing money, and this is to uncover the political that is inherent in money in the first place. So where we don't use money as a tool to further political goals, but where we find the politics in money. And this is very much thought to be like complementary to understanding the mechanisms, the balance sheet mechanisms of liquidity. So I understand this as a complementary exercise. So the approach that I take is to say, okay, we are in the historical phase of what is often called modern money. And to get to the political core of money, we have to look at its ontological status. So this is fancy wording for saying we are interested in what money is as opposed to what money does. The answer is money is credit. I think that's not particularly controversial in this group, probably. And credit is the relationship between a borrower and a lender. And so you have a hierarchically structured social relationship that you automatically have when you make a promise to repay and another actor accepts this promise at the same time. Now, if you accept this as what money is, then you can immediately sort of infer the innate power sources of money. One is that, of course, credit gives us the power to overcome today's resource constraints, right? We want to unfold economic activity. We cannot financing it, so then we cannot do anything. But if we can get credit, we first do the economic activity, then we make money out of it, and then we can repay our loan. So this is one source of innate power, but I won't look at this very much in today's talk. What I'm more interested in is the second innate power source, that these social relationships that create credit money are creating money as follows logically. And that we very often discuss about money creation as a shared power between the state and banks or financial institutions. But behind the power to create money actually lie two different elements, if you want to. And one is liquidity. This is what we discuss very front and center. And my argument is to say, if you want to get to the political, so the geopolitical, of course, is the level that we're interested in today, then we also have to look at the rule setting, because creating money obviously means the actors who create money can determine how much liquidity there is in the system, or if they destruct money, that the liquidity goes down. But it also implies that they can decide who gets access to this liquidity and under which conditions. And I even conceive of the rule setting in an even broader sense that includes also all the norms that are around money creation. So this would entail banking regulation, but also who is allowed to have a banking license in the first place, etc. So it's really like a broad understanding of rule setting. So this is sort of like the approach that I'm taking to try to really tease out where's the politics in global liquidity. So now if we move to the offshore dollar, which is of course a very important element in global dollar liquidity, then we get into a bit of terminological or a bit of trouble in terminology. Social scientists would say we get into conceptual confusion. And I try to clarify that a little bit before we move on. So I think we're all familiar with the unit of account, the descriptor in Keynes terms as the US dollar. Then we have established the language of onshore and offshore US dollar. And the onshore-offshore dichotomy is seen from the United States, right? So everything that is not within the United States, which is outside the shore of the United States, is offshore money or offshore US dollar. And I think this dichotomy is very, very helpful if we're interested in global liquidity and try to understand how what is happening in terms of US dollar creation outside of the United States and what is happening inside the United States is sort of interacting, and what's sort of like the basis of global dollar liquidity. Now I say, but if we also interested in the rule setting element of money creation, that dichotomy is a little bit too rough. And we actually have to look or take in the logic of the location of where the money is created. So onshore, of course, in the United States. And then I propose to break down the offshore category into two. And the one is specifically offshore financial centers. And the other is all other countries which are neither the United States nor offshore financial centers. So rule setting really focuses on offshore financial centers because their business model, to cite the BIS paper, very much is to provide a environment, a jurisdiction where there are very low rules on all kinds of financial transactions, right? And so I want us to take this difference into account. If I can borrow a little bit from Katharina's language, she can tell me whether that's a proper usage of it. You have US dollar in all of these three types of locations, but there's a different legal code that comes with the US dollar depending on the regulations you have in these places. So I distinguish between domestic dollar, that's obvious. I use the term euro dollar to refer to US dollar traded in offshore financial centers, simply to show the historical continuity between the euro dollars in the 1950s, created in the City of London, as among others, as a way to circumvent Regulation Q in the US, and then foreign dollar as the US dollar that's created in all other places. So, but I don't just want to be conceptual here. I also did bring a bit of an empirical analysis that I think is important if we want to get at the geopolitics of global dollar liquidity. And here's a number of large economies and emerging markets. And I distinguish, so what I look at is cross-border loans. So this is the BIS database. That are denominated in US dollar, and I distinguish between those that are towards the United States, those that are towards offshore financial centers, and those that are towards all other countries. And what we can find, to, for example, zoom in to Germany, which I found surprising, I must say, when I first did analysis, is that the onshore dollar is a small amount, that the foreign dollar is much bigger, but not smaller than the euro dollar. And you can see this pattern repeat with the exception of Britain in most of these countries if you focus at 2023. So in all of these economies, the euro dollar claims and liabilities are larger than the foreign dollar claims and liabilities. And together, this offshore dollar category is far bigger than onshore dollar. So we have more liquidity coming from the offshore dollar for these economies that I selected here. And particularly the offshore plays an important role. And what I found in my interviews with lawyers and bankers in these particularly emerging economies is that this is a very conscious choice. And so I want to go to the geopolitical consequences of this in the remaining time that I have. And I think the first implication is that is probably not very controversial, is that economic actors can go into US dollar denominated debt or have access to US dollar liquidity without having a direct relationship with the United States. And I call that a way of indirect rule. For me, this really reminds me of like the historical phase where the center of power is not directly ruling globally, but indirectly. And the indirect actors are offshore financial centers and non-American banks therein. Then I think what's important to come to the politics of global liquidity or geopolitics is also that the offshore US dollar creation, the possibility that is there is, of course, again, not so surprisingly, the capacity to German international liquidity. So that's very important element of money power, but to set, select, or circumvent the rules as well. And to set the rules, this is, of course, first and foremost, the US, but then you have the rules in the respective locations as well. Select means that as the borrower, and again, in emerging market economies, central banks and multinational corporations make a very conscious choice here to say, well, with the US dollar in the US comes this set of regulation. With the US dollar in, let's say, Tokyo, in Japan, comes this set of regulations. And in the Bahamas comes yet another set, or Cayman Islands, a set of regulations. And then you also have the power to circumvent the related rules, right? And I think this is a very important geopolitical point. So if we look what this means for like the global order bit, is that emerging market economies through these offshore financial centers get access to creditors that are otherwise unavailable. You can see this particularly like in the Greece case. If it wasn't for offshore and particularly offshore financial centers, the access to the US dollar would be very limited. You can also see that countries like, for instance, Vietnam or the Philippines have the ability to increase their foreign direct investment without necessarily having a very strong rule of law, because they tap into the legal system of offshore financial centers. So they too have an interest in the system. That's why I'm telling this, is because there's a lots of rhetorics, of course, of challenging the US dollar dominant system, but they too have an interest. Then for the US, I think this is a bit more straightforward. We have this trade-off between rule setting and liquidity. The same way as you have this in the domestic economy, it applies globally as well. And then I think the important element that I want to drive home here is that offshore financial centers and then yes, banks are important geopolitical powers in the current monetary order. We have a shift from towards non-Western OFCs, and it does make a difference whether this US dollar liquidity, at least in my understanding, comes from the Cayman Islands or comes from Singapore, for example. And so if you try to get like this rule setting, offshore financial centers, Eurodollar perspective into the analysis, what it does is that it moves us away from this continuous discussion whether the US dollar will remain dominant or not, and rather gets us to, under the condition of continued US dollar dominance, we still have geopolitical constraints on that dominance without necessarily immediately moving to replacing the US dollar in the global monetary system. So I think I'm up with my time, and hand back to Katharina. Thank you.
Thank you, Andrea, and thank you for being so precise and staying on time. If you unshare, then I think we can allow Linda to bring in her slides. Thank you so much. And
here, stop share. Okay.
yeah, and now I think Linda can share her slides, and we'll continue. Just a reminder, everyone, again, if you are not speaking, please mute yourself. Sometimes there's interferences. So to minimize that, please keep to the rules. Linda Goldberg, from a researcher at the Fed in New York, will give us her comments on global liquidity and geopolitics. Thank you so much for coming, and looking forward to.
Thank you, Katharina. Can you see my presentation and hear me fine?
Yes, very good.
First, I just want to say how exciting this is and how nicely I think our presentations will fit together, and it's exciting to see these two very different kinds of perspectives brought into the conversation. Whatever I say are my views and don't necessarily reflect those of the Federal Reserve Bank of New York or Federal Reserve System. So what I'm going to do in my kind of kickoff slides is I'm going to focus on global liquidity, a little bit of a different perspective, but very complementary. I will start with a schematic representation that I think is useful for understanding the historical evolution, and it actually fits nicely with Andrea's pictures about the cross-border and local funding flows internationally through the BIS statistics. So, we'll see that. So I'm going to emphasize 3 separate phases of global liquidity flows and focus on lenders, borrower types, and some channels for these flows. I'm going to argue that there are external and internal capital markets within banks that influence the sensitivity of these flows to different kinds of global forces, that geopolitics influences the modes of entry. I'll talk about different international roles of the dollar, and then I'll talk about some of the two, in particular, official facilities that the Federal Reserve has with foreign central banks, foreign international monetary authorities in this global liquidity space. So that's where we're going. So first, this is a stylized depiction of global liquidity, essentially, from my view. You have in this picture the global bank, and then you have the borrowing country that's in this dashed orange box. And within the borrowing country, initially, we had domestic banks and some non-bank borrowers. So if you think about the cross-border funding that Andrea actually showed us in her visualizations, up through the 1980s, this happened by global banks having some lending that they did to other banks outside the US. And so that would go to the domestic banks of other countries. And those banks would then take that liquidity and on-lend to borrowers in their economy, non-bank borrowers. Another thing that the global banks did early on is they did some direct cross-border lending. Initially, it went mostly to official borrowers, so governments, for example. Then you had an opening of local markets to the entry of foreign banks that happened in the 1990s through the early 2000s. And sometimes this foreign bank entry, so it's the ability of a global bank to also set up a branch or subsidiary in a hosted market, sometimes that came about because that country had a balance of payments crisis or banking crisis, that there was some geopolitical instability, and they allowed in the foreign banks as a source of strength and credit provision in their markets. So in that case, the global bank did lending to domestic banks as it had before, but also this bank sitting outside the parent could lend to its own affiliates that were hosted by hosted in the foreign country. That's called intra-bank lending or internal capital markets with those hosted banks. And both types of banking institutions would then lend to the non-bank borrowers in the country, in addition to there being cross-border flows. So Andrea talked about local claims and offshore cross-border claims. This is the cross-border piece, this branch and this branch. And the local claims are coming from these guys, the hosted foreign banks that are lending internally within the country. Then you get into, after this period, the last phase, I think, which is, or the most recent phase, which is the rise of market-based financing and international debt securities. And in this setting, you have everything you had before, but now you have non-bank and market-based financing. That's a possibility. And these non-bank financial institutions around the world, they could also be involved in funding the domestic banks or lending to non-bank borrowers that are in these economies. So each type of arrows, these black arrows and these blue arrows, each of them has a distinct sensitivity of funding costs to global or U.S. monetary policy rates and to risk sensitivities, risk appetite changes. And you could think of geopolitics as entering the willingness to have banks host and be hosted, and the types of communications, and maybe Andrea was talking about rules that allow for this kind of funding and put guardrails on some types of activity. So where are we now? This is another aggregate way of looking at the country-specific data that was already shown. And you have on 4 pictures, each are from borrower country perspectives. So, and the upper panel here is for advanced economies as borrowers. The lower panel is for emerging market and developing economies as borrowers, recipients of funding from outside. And then what are the types of institutions that are getting that funding? The left column is banks getting funded, and the right column is non-banks being funded. The red is the traditional flows through other banks, and the blue is flows through international debt securities. So the red is cross-border lending, and the blue is market-based finance. And what you could see here is that the red, which is bank-based finance, is still the dominant force in funding banks in emerging markets and developing countries. It's still the dominant force across banks, so bank-to-bank lending, even for advanced economies, although blue international debt securities has been playing more of a role since just before the global financial crisis. And then you see a big evolution of what's going on cross-border in how other borrowers that are not banks are getting their funding, with a much, much larger role for the blue international debt securities and market-based finance, especially for emerging markets and developing economies. So let's turn for a minute to other uses of dollars around the world, and just to kind of highlight, it's not only in lending, but let's kind of look at the structure of this. So this is taken from the ECB's International Role of the Euro report, a great report that they put out annually. It shows different categories of dollar use in official foreign exchange reserves. That's kind of the foreign assets held by central banks. In international debt, where you could think of that market-based financing that I just showed. In international loans, which you could think of as the bank flows that I just showed. Then in payments around the world for different kinds of transactions. And then in anything that's foreign exchange turnover. And you could see that the dark blue bars, the dollar share, is the strongest, the most actively used currency in all of these transactions, followed next by the euro with a big gap across the other roles, and then the Japanese yen. Now, there's more focus on all of these roles since the Russian invasion of Ukraine and the new financial sanctions that were imposed on Russia, including on their use of the global payments system SWIFT. But from a geopolitical perspective, the ECB looked to see who was talking about getting out of dollars and what actually happened. And they found basically announcements that things were going to take place, or it's an intent to get away from dollars, but nothing really material there. Getting back to the elements of the international monetary system, just briefly, in the post-World War II period, the dollar became the central currency in the international monetary system. It's still the central currency in terms of current countries managing their currencies vis-a-vis US dollars. So about 20% of countries actually have a an official anchor to US dollars, and that's 37 currencies, and 26 to the euro. Despite geopolitics, in recent years, there's no large changes in this. The currency composition of central bank foreign exchange reserves is often discussed in relation to geopolitics and geoeconomics. The dollar share of reserves has declined in the past decade, but in my recent research, I show that this is not a generalized move away from dollars in central bank portfolios. Some of it, like a third of that, is associated with Switzerland's monetary policy framework. It's not about dollar preferences. And then geopolitical considerations may come into this to the extent that there are some countries with geopolitical distance from the US. For example, China, India, Russia, if you look at voting patterns at the United Nations, there is some role for these particular countries in possibly moving away from dollars. So let's go into official liquidity, and I'll just almost wrap up here. When we go back to these kinds of environments for how funds flow across borders and the kind of issues that Andrea brought up, there are times when domestic banks or non-bank borrowers need dollars, and they look for offshore funding for their activity, and they can't get those dollars to the extent that they need them. So, so you get stress periods. I'm going to jump ahead a slide, and I don't actually have the most recent slide in here. Okay, so let me just talk through crises. So there are times, I'm going to just leave it on this. There are times when shocks hit international markets, and there are dollars that are needed by banks and by borrowers. And in the banks, for example, or in the non-bank institutions, if they can't get those dollars, they could significantly contract credit provision within their economies and across border. In the global financial crisis, it was mostly Euro area banks and Japanese banks that had sharp increases in their dollar funding needs. They then turned to, many of them, to the US branches of their own banks as a way of sourcing dollar liquidity in the US. And those banks got the liquidity at the discount window or facilities at the Fed. Other facilities at the Fed are term auction facilities. And then they sent it back to their parents. The swap lines were then developed to let those parent banks borrow dollars essentially directly from their own central banks instead of doing this cross-border activity. In the pandemic period, we had disruptions to corporate funding markets, and corporations that needed liquidity turned to banks where they had essentially committed credit lines, so lines of credit outstanding. And those banks then had to come up with the dollars to meet their own needs. So even foreign banks that had branches in the US needed more dollars. They actually turned to their parent banks outside the US for dollar needs. And so, again, the swap lines were activated. In some cases, there was an effort to sell off US treasuries to get some of that dollar liquidity, and that leads to propagation and amplification of the strains. So the Federal Reserve has now two methods, two main methods for getting dollar liquidity to foreign counterparts in times of these types of stress periods. These are central bank swap lines and FEMA repo facilities, that's Foreign International Monetary Authority repo facilities. And for the swap lines, these are between the US and some central banks. Some of them are these types of offshore, they're financial centers, offshore financial centers. They're outside of the US, but the offshore piece sometimes has a different connotation. This is between the US, the ECB, the Bank of England, and so forth. Since March 2020, there's also a facility where account holders with the Federal Reserve, where the Federal Reserve is managing some of that foreign central bank's treasury holdings. Those could be pledged against this facility, and instead of the foreign central bank having to liquidate their treasuries, they could basically repo them or borrow against them. And this gets that dollar liquidity more broadly available to anyone with these kind of official accounts. And these are, both of these facilities reduce near-term dollar funding strains. They reduce tail risks that could be damaging, and they support credit provision domestically and abroad. So this set of approaches is likely beneficial for the robustness of global liquidity, and also reinforces some of those international roles of the dollar. So I'll stop with that and give it back to you, Katharina.
Great. Thank you so much. Thank you to both. I'd like to give you an opportunity to respond briefly to one another, and maybe I can also ask both of you to clarify your definition of liquidity. So I think, Linda, you have in one of your pieces a very explicit definition of liquidity, which is sort of the total amount of, the total volume of financial assets that are easily sellable in international markets. I can look up the exact quote. I got it here somewhere. Hang on. Let me just find this. Global liquidity refers to the volumes of financial flows that can move at relatively high frequency across borders, was yours. I got the sense a little bit from Andrea's presentation that you made the point that actually credit is the alternative for money. If money is not readily available, people turn to credit, and credit in that sense might be more liquid, or at least more readily available. I'm just wondering whether we could just clarify these conceptualizations. We started our whole seminar series with Charlie Calomiros giving us a definition of liquidity. We're always coming back to the concept. So maybe as you respond to each other, you can briefly say a few words about that. But then I just want to hear you, and I myself and maybe Matthias might have other questions, and then we will open it to the floor. Again, if you have questions, you can put them in the chat or you can raise your hands. Andrea, do you want to start coming back?
Okay. Yeah, thank you very much. Thank you also for your presentation, Linda. It's always so nice to listen to you. I also read like lots of your publications for my own research, and so I don't think there's a lot of points of objection, so to speak, that I would raise. But I would like to ask a question, I think, and this is, and you choose to answer it or not, but in terms of the geopolitical consequences. So in a sense, if I understand you right, you're saying, so right now, at least, we can't see the geopolitical fault lines that we see currently having a negative impact on the use of US dollar across these different types of uses that you say. And my first question would be, in how far you think that this is maybe also a question of time, right? When the effect actually will be visible. And the second question related to that maybe a little bit would be to say, you introduced the two different instruments that the Fed has developed to address financial stability issues, which is the swap lines and the FEMA. And there is like one of the distinctions is that in the swap lines, or this is my phrasing now, of course, you do have a hierarchy between permanent and temporary, and between those who have access and those who have not. So this would lend the swap lines as a geopolitical tool, while the FEMA is to all account holders and therefore has less of this potential. So I'd like to hear your views on that if you'd like to comment. And then on the question of the definition of liquidity, I don't think that I would have a different definition than what you read out from Linda's. I just realized, so in a different paper, and this is why for this presentation, I stuck very closely to actually just the loans, because this is easier, right? Because as soon as you get into the bond issuance, you get the combination of so many jurisdictions that it becomes, particularly in the presence of lawyers, it becomes more difficult to make these categories and to say here we can observe that rules are circumvented via this offshore financial center vehicle, because it becomes very difficult to place the instrument in one certain location in the first place. So the problem that I then have is, like, in a different paper, what we're trying to do is to actually say how big is this offshore system in terms of instruments. And then if you go through these different instruments that obviously are differently liquid in the sense of how readily the money is available, is in which instance do you have double counting across the different instruments, and can we give this total volume in a number? This is also why I gave you a share of one on my presentation, not in trillions, in trillion US dollar. So I do think there is something that maybe I haven't fully grasped in how we can conceptualize liquidity without these issues, but roughly I would say we're in the same camp.
Linda, do you want to comment or question?
Okay, so I guess the first question is on, well, first of all, thank you for reading some of my work. So the first question on geopolitical consequences, you know, I talked about, and I showed the picture of key indicators. So that's where in aggregate you don't see these things changing a lot, but there could be some things that are missed by these aggregates. For example, you could have much closer payments relationships and trade relationships, as we see between Russia and China, India, Brazil, for example. So that is an evolving or tilting pattern of activity, and there could be bilaterally different currencies used on those types of transactions. There also, I didn't talk about international trade transactions, but there could also be some shifts, again, not global at this point, but some shifts bilaterally in what currencies are being used for settling and invoicing international trade transactions. So the fault lines, as you call them, there could be evolution in kind of some narrower channels, but not broad-based globally. You asked, is it a question of time? You know, all of these roles of currencies are not immutable. These are choices in general that different market participants and governments have on official transactions. And you could always think through what are the conditions for that would have to be satisfied for market participants to change how they use dollars or other currencies. You asked about the swap lines and FEMA repo facilities, and used some language about those. Let me clarify that language a little bit, or elaborate a little bit on that language. So the Federal Reserve has a network of bilateral agreements with a number of, there's the, I'm going to go through the list, but the Bank of Japan, the Bank of England, the ECB, the Swiss National Bank, the Bank of Canada. Who am I missing? Jump in if if I'm missing them. Has standing arrangements with these central banks for these dollar use. There's auctions that could take place weekly as needed with these central banks if institutions under their jurisdictions need dollars. These are dollars that are priced above standard market rates a bit. And so these are standing facilities. There's also temporary facilities, which is so the standing swap lines, the temporary swap lines, which are activated by the FOMC with countries by decision. So they're not always in place. And so, so that is a much more limited group than the kind of globe where other countries might also need dollar liquidity at times. So they could get that liquidity in some cases through the network of standing central banks, or possibly not have that access. And so the FEMA repo facilities that were introduced in March 2020 basically says, if you have assets that could be pledged as collateral, if the central bank has assets that could be pledged as collateral with the Federal Reserve for a repurchase transaction, and that's U.S. Treasuries, then they could basically liquefy their assets, their savings, getting cash dollars for it without the Federal Reserve kind of, that's on their demand basically. So that requires having an account, and it requires that foreign authority wanting to do that. That's their call, and there aren't conditions on the use as there are on the swap line funds. So yes, this is a different mode of access, and it comes with different kinds of constraints. And of course, there are other types of swap lines that are set up by other central banks. For example, the Central Bank of China with many different countries, and they have their own set of uses and conditions.
Thank you. Let me maybe start the discussion by going back to some of the data, Linda, that you introduced, is the rise of non-bank lending or non-bank lending, what we also sometimes call shadow banking, also the whole world of what the lawyers like to call structured finance that emerged since the 1970s, and of course have made the management both domestically and internationally of liquidity more challenging. It's more difficult to locate. It's not centered in banks, but banks are tied into it. And I would like to ask more generally the question, actually, is there anybody still in the driver's seat in terms of the management of global liquidity? Where does the power actually rest? I think Andrea was pointing out that actually a lot of power also is vested with the private lenders that are creating what I think Perry Mehrling would call credit money or private money rather than state money. But given the importance of lending relations in general for liquidity, somehow they always implicate also the lender and dealer in these cases of last resort. I already see Perry sort of turning on his little image, so maybe he wants to chime in and clarify my question, but I'm just going to throw this out at you. It's sort of, what is the transformation of our financial system with the rise of non-bank lenders? How has that complicated also the geopolitical effects of liquidity management? And maybe Linda, you start first this time, and then we'll toss it back to Andrea. And again, I invite others to raise questions. I'll check in the chat.
Yeah, so I think the non-bank side is very, very heterogeneous. It encompasses insurance companies, pension funds, mutual funds, private credit firms. And for example, in the US, we have also a fragmented system of regulation. So we have, basically like a dozen different regulatory entities overall. So it is, there is oversight on this from a regulatory standard, but it's not a unified regulation, and there's much less transparency and available data about the transactions. The Financial Stability Board has a lot of work that is being done on kind of monitoring and looking to set up frameworks that are more unified for non-bank financial institutions, but this is still very much a work in progress, and also getting the data standards and transparency. So where does the power rest? I think probably you could say it's more diffused. You also have some work from the Bank for International Settlements researchers that shows that, and this kind of often is something that goes on, that there's migration of activity in terms of where some institutions are incorporated, migration of activity to less regulated or weaker regulation locations. So I think these are all things that are under discussion. Andrea.
Yeah, thanks, Katharina, for the question. Of course, I think this is like right spot on the question that we need to ask, both from the perspective when we want to do liquidity management as good as possible, from good meaning creating a stable system, as stable a system as possible, but also, of course, from these larger geopolitical questions on what a changing monetary system would bring and would look like, and who will be the winners and losers of that transition. And I think if you want to, like, I think we've seen it in Linda's I think it was BIS statistics that she showed, that the non-bank financial institutions are particularly important in the section of advanced economies, and then in the market-based financing, right? So in the international debt statistics, which is like bonds and then other financial instruments. But I would say, from the perspective of the argument that I tried to make in explicitly saying, Linda said diffuse, and I'm saying, like, this is indirect rule, right? You do have the center, which is in the United States, and which has the jurisdiction of the unit of account, but the geographical reach and the means of controlling it from the center, there's a gap between the ambition, or maybe by now it's also some sort of necessity if you don't want international trade, etc., to come to a grinding halt, So between the geographical reach and the actual like possibility to control this from the center, there's this gap, and this gap is filled, in my argument, partially by offshore financial centers, but literally, like, I think why you refer to Perry in a sense by private actors, right? And this I think is very important, because it's not just a question of public versus private power, but it's also private power that is outside of the United States. So you have a very different relationship between these private actors as opposed to the public-private actor relationship that you would have within the United States. And so I would say there is someone in the driving seat, but it's very much backseat driving, right? And this is the indirect element that I wanted to highlight.
So maybe I could respond to that for a second, which is, so let's like run with that, a bit. And there are these private actors, but within the local economy, the economy that's receiving these funds, if you're on the banking side, the rules that are applied to your banks in your economy can put, restrictions around the characteristics of funding flows and the players you're receiving those funding flows from. The questions are more about when you're not getting the banks receiving these funding flows, but for non-bank participants in these markets. So what are they being exposed to, and how do you set the guardrails for them? Now, suppose you have a majority of funds coming to corporations, the cross-border funding, and suppose a majority of that cross-border funding that corporations receive are from these diffuse players externally, and then there's a disruption to flows through those non-bank financial intermediaries. The non-bank financial intermediaries don't have direct access to official liquidity to kind of fill those gaps. And the corporations, the private players, don't have that access either. So it's like an interesting space for kind of thinking about how you limit big disruptions in those markets, with non-bank financial institutions playing so much more of a dominant role.
Great. Thank you. Let me just open it to questions. I don't want to monopolize the conversation here. Matthias, you get the first question, but please, others, raise your hand or send a message in the chat. Matthias, and then Anna.
Thank you very much, and good afternoon. I missed the 1 hour time delay, but I was able, thanks to Katharina, to join at 5:20. Great presentations, and I wanted to ask a question one more time about the system, governance, and control. And in a sense, I wanted to ask if I understood it correctly, that the thing that caused the greatest problems for the US was that the non-bank actors, in order to fill their funding gap, the dollar funding gap, started to sell the treasury bonds, and in that sense contributed to the turmoil in the treasury market. And if that is so, then my question would be, would it be correct to see these swap lines that you announced, in a sense, also the FEMA, as a way to mitigate the potential for disruptions from the non-bank based financial sector to the US Treasury markets through opening these new venues for providing liquidity? Is that the right way to read it? And if that is so, was there any backlash that the Fed experienced for opening them? Because, I mean, it's a very technocratic requirement to do that, to manage the global system rather than the domestic system. And I'm wondering if the Fed had any problems in communicating that. Mm-hmm.
So the swap lines and the FEMA repo have as counterparts foreign official institutions. So there's no direct funding that the Federal Reserve, through these facilities, provides to any foreign private players, banks or non-banks. You know, the way that these are implemented is that the transactions are with these key, strong central banks around the world. And those central banks take on the credit risks of their counterparties that are banks. These are collateralized transactions, but still, you know, they engage with banks primarily. And then the banks have a role in on-lending to, in their economies, to whoever their customers are, which would include non-bank financial institutions. So, so I think the question then is, does that kind of pass through of liquidity happen, and happen as quickly as is needed to limit amplification of bad things, shocks that happen in the economy? So I think that's still kind of a question. What happens if the banks borrow from the official facilities and then they hoard the liquidity instead of passing it on? You know, I leave it to others to comment on whether the communications have been as clear as they can be around these facilities. I think they have actually been very well received by market participants, and just the announcements of these facilities and improving terms and frequencies of them have been stabilizing in times of stress. And I would emphasize that having these facilities, you know, if the US and the Federal Reserve provides dollars to foreign central banks through these facilities in an integrated international financial system, that keeps dollars within the US available for lending within the US. So it actually supports the continuation of credit provision in the US, as well as kind of helping cut that amplification abroad. So I think that is a useful way to think about the communications on it, and that these kind of basically reduce overall strains that are make things difficult for a lot of players.
Great, thank you. Anna Gelpan next, and afterwards Perry Merling. Keep raising your little hands. Anna.
Thank you, and I'm so sorry. My phone turned itself on in my pocket, so everything is all the interference you've had is my fault. And please always feel free to mute me centrally. So I was fascinated by two things in both of these excellent presentations. One is the way in which Linda described the Fed facilities, the most recent kind of round post-traditional swap lines. And it occurred to me that you're framing it in terms of financial stability, which I think is, you know, quite sort of right and sensible. But it's also, I think, entirely kind of coincides with the U.S. interest in the use of U.S. dollar, right? Something that sort of, let's say, China is very explicit about. You know, we want, you know, renminbi to be used in all these various settings and more international transactions. So the whole renminbi internationalization agenda. And for a long time, the US hasn't, we haven't really said, our policy and political goal, right, is such and such use of the US dollar. But financial stability happens to coincide with any such interest, right? And I'm wondering historically, at what point does a policy interest in financial stability coincide with the policy geopolitical interest in the use of in the international use of the US dollar, right? I mean, I'm not sure if we have something like the ECB report, right? The international use of the dollar. If we do, I totally missed it. We have a report on on currency manipulation, but that's rather different. And then the second thing that's very separate, but the word jurisdiction keeps cropping up. And I find that absolutely fascinating, right? Because jurisdiction is a proxy for many kind of power type things that we're discussing. And it certainly doesn't only apply to banks, but I do think that framing a lot of these questions in jurisdictional terms could actually be rather interesting. But that's sort of an aside. Thank you.
Do you want to start, Andrea?
Yeah, sure, happy to. So maybe quickly only, because I think, Linda, you're much better placed to respond to this question about the coinciding of an interest in financial stability and a geopolitical interest in having the US dollar as the dominant currency. I'm not so sure whether I would frame this as like coinciding, but rather that being responsible for the financial stability and being successful in achieving it is sort of a precondition for being able to use it at the US dollar as a geopolitical instrument. So if you align both, then that's probably a sign of that you can achieve the political goals or geopolitical goals that you have beyond pure monetary questions, so to speak. So for me, it's more like you have to get this alignment, because otherwise you run into problems. And I think we can see the reverse, right? Why it didn't happen during the financial crisis, where immediately the US dollar's global role, or the legitimacy of the US dollar's global role, has been put into question in terms of like, does the US provide the financial stability that is the responsibility of the provider of the world's key currency, so to speak. On the point of jurisdiction, I think you are absolutely right. I struggle with this term a lot because, and I also use it a lot, because it's somehow a bit of a fudgy term, because on the one hand, what you try to describe, at least if you come from this offshore financial center perspective, and the question which role they play in the international financial system, you use it to really say, look, here the offer that they make is to say, in our jurisdiction, so in our place where our rules and laws apply, there's very little on what we demand from non-residents in terms of reporting, in terms of tax paying, in terms of any sorts of regulation. You have different shades of gray, where you also have like what is called like mock compliance, right? Where you say we agree to Basel, but then we never really enforce it, etc. So this is the one way where you want to say, where we say where the rules are, while at the same time sort of recognizing that at least in the traditional offshore financial centers, they are very much tied back to the UK and to UK power. And so you don't necessarily refer to these places as nations, although of course many of them actually are. But then you also have the flip side, and this is what makes me my head spin a lot, is the question of US jurisdiction, because very often you say, well, US jurisdiction is limited to the United States, but then actually we know also from Cornelia Woll's work, of course, that that's not entirely the case, right? And if you're Deutsche Bank and you see where you actually regulated, it's much more the US that enforces jurisdiction. So there's very much this kind of question: where does the jurisdiction end, and how do we pin down what these kind of malleable, where sort of the borders between where one jurisdiction ends and the other starts is more malleable than the actual national borders. So yeah, this just more as a comment than actually having an answer to it.
Thank you. Linda?
Yeah, so, I also agree it's in the post-war period, with the dollar being central to so many international transactions, this kind of being a responsible steward is, important for domestically as well as internationally. So it's financial stability, but it's also real economic activity, as I mentioned. The U.S. Policies about the dollar are set at the Treasury, not at the Federal Reserve. So these are liquidity facilities that are set up, which again ties more directly into these short-term disruptions in global liquidity and funding markets. It's not kind of lending that's done for any long-term use. Now, my personal view, and all of this is my personal view, is that the international roles of the US dollar on net are a strategic asset of the United States. There are trade-offs associated with different uses of dollars, and there are a bunch of different implications. But it's just personally, I don't think that these should be taken for granted. But that said, that's not an activist approach to promoting dollars, but it gets back to responsible stewardship.
Thank you. I have Perry Merling next on line. Perry.
Yes. So this is really quite fascinating. I thank you both for your presentations. I was looking forward to this for a month. So I notice that both of you, when you're talking about quantities of credit, and the prices haven't been mentioned yet. So and you talk about regulatory arbitrage, moving toward less regulated, as opposed to finding the cheapest credit. So the arbitrage that's involved in price. So maybe you want to just add something to that on that score. The liquidity, of course, of dollar markets is one reason that the emerging markets are borrowing in them. Because they can borrow more cheaply than they can in their own currency, and they can't hedge anyway. There are no hedging markets for the peso against the dollar. So the price across these different dollar markets, there's going to be arbitrage. And then link that to, and this gets to Katerina's question maybe, U.S. monetary policy. Okay, that U.S. monetary policy is, I would say, and maybe you can agree or disagree, is basically global monetary policy through these channels. And in that regard, this whole period you're talking about is a period largely since the global financial crisis of zero interest rate policy, okay, that has been changing rather dramatically in the last 2 years. Okay, so we've been in expansion mode, and now we're going into testing mode, stress mode, higher interest rates that are being transmitted globally through these markets. So moving from quantity to price, please. Thank you.
Who wants to go first? Yes.
Katharina, can we maybe collect some questions?
Yeah,
because...
good point. We have 10 more minutes. We start at 12:10, so we have 10 more minutes. I have, after Perry, I have Waltraud Schelkle, and then I see Nathan Coombs coming up. I think we have time enough for each just responding now to these questions, but maybe we should just be briefer in our responses. Andrea, do you want to go first?
Yeah, so to Perry, I would answer, I think more in terms of costs than in terms of prices. And that seems to me what reflects the decision-making of seen from emerging market actors, right? So yes, of course, the interest rates play a role, and at home they are higher, and so borrowing offshore is cheaper. But then there's also between those different markets, and this is where the regulatory costs come in, where they say we can't follow what the SEC wants from us in terms of reporting because we're big enough, or maybe we are just not able to do that, so rather let's go to the Bahamas. So I think it's not just simply the price of getting access to the liquidity, but this larger sort of what I would call costs involved in getting access to US dollar liquidity and then trying to find your best option in these different markets.
And I would maybe just comment on your point that your statement that US monetary policy is global monetary policy. So I agree with part and disagree with part of that statement. So it's certainly the case that there are significant spillovers of US monetary policy into foreign rates, but there's also ample evidence that countries are able to use their own monetary policies to especially deal with local shocks while still being subject to the global financial cycle. And that is driven by a lot by US monetary policy and also risk sentiment. So I think that they still have some autonomy in setting their own policies, but there is a lot of spillover from the US.
Thank you. Waltraud Schelkle from the EUI next, please, and then Nathan. Waltraud. You need to.
Okay,
yeah.
so and if the internet connection doesn't work, then tell me. I would like to come back to Katharina's question from the point of view of the central banks. If one shows these graphs with, the role of the dollar in offshore finance and so on, it seems to be an implication that to some extent it does show the power distribution between central banks. Is that what you would say? Would you, for example, think that the ECB would have a more effective policy that it can wield at its discretion if it had the role of the Fed in offshore markets? Or would it just meet another constraint in the diverse market conditions and being very, very careful of what it can unleash as it is arguably now? Thank you.
Thanks. Who wants to go first? Andrea, what do you think? You're the offshore expert here.
Yeah, I know, but the problem is that I missed part of the question, and so I was trying to make sense of it, but I'm not sure I fully understood.
It's in the chat.
Let me just read it. Please, another way of asking Katharina's question is mainly, Andrea, would the ECB be better off as an effective central bank if the euro played a bigger role as the currency of choice for offshore finance and reserve holding? This seems to be the implication of showing graphs with the share of the euro and foreign dollar in offshore finance. But I'm not so sure a larger role in financial markets for banks and non-bank debt could just be an additional constraint on the ECB's policy response. So in a way, if the euro wants to really compete with the dollar, if I can rephrase, would it have to also sort of get into your offshore world a bit more?
But also, would it be more powerful?
Yeah.
Would the ECB be more powerful? I think this would come down to monetary statecraft and how well they would do it, because as Linda just said, right, there's costs attached to it, and the question is how good you are geopolitically in managing these costs. And I think partially this is also the reason why the Chinese, despite all of the rhetoric, are rather not reluctant, but sort of very moving very carefully in terms of like how much internationalization they want. So I don't think you can generally say, yes, if the ECB would be more powerful if it used the offshore channel more. It would require good monetary statecraft, and that, of course, within the Eurozone is much harder to achieve than within a nation state.
Thank you. Elena, unless you want to add anything, I would ask Nathan to ask his questions, and then maybe you can combine both. Nathan, please.
Yeah, thank you both for the interesting presentation. So my question is more to Linda, because it's sort of an insider type question. I'm just wondering, given the swap lines and repo facilities for foreign central banks and the conditions under which they're being activated, and at least in terms of the repo facility, as I understand it, created, is there any concern in the Fed that this is providing a kind of a backstop to global shadow banking or US denominated global shadow banking? Because what I've understood so far, and I could be getting this wrong, is that this is created about concerns of spillovers and systemic risk. But in addressing the problem of spillovers and systemic risk, it's kind of validating to some extent those kind of non-bank uses of liquidity, perhaps via the central bank. Or maybe I'm getting this wrong, but that's my sort of general question of whether there is a concern with global shadow banking in the provision of these facilities.
Linda, do you want to respond? Maybe we have only 5 minutes left. Maybe you can also both wrap up any other comments or thoughts you want to share. And Matthias, if we can squeeze in, we'll try. But other than that, Linda, do you want to go first?
Yeah, so I don't think about this in terms of being a backstop to global shadow banking. I wouldn't frame it that way. Again, we're however we got here, and we're in a world with extensive use of dollars, and in some ways you could think about these liquidity facilities as in some cases reducing some tail risk that comes about, in large systemic events, which is primarily what the swap line activation is about. That's not a statement that's specifically about non-bank uses or shadow banking uses. It's kind of systemic costs, as Perry was talking about. And Perry, I very much appreciated your question too. So I don't think about it from that perspective of kind of only shadow banking. I do think about how amplification of strains can make stress events much, much worse over time and broaden those across institutions. So if there are some ways that you could limit that amplification without distorting excessively, at least, market activity and having it function well in normal times, then these are valuable stabilizing tools. So that's kind of how I think about that. Andrea, I don't know if you want to jump in.
So I was thinking that maybe a way to reflect on those swap lines and the FEMA facility in terms of the effect of stabilizing the global financial system, shadow banking included in this, is that in some way what you can observe, if you look historically, where you have the beginnings of the euro-dollar markets in the 1950s, and both the Federal Reserve and the Bank of England more or less saying, like, you know, you do this on this offshore balance sheet, but we're not backing this up, right? Because this is kind of risky business. And from that, you get different episodes after regional financial crisis, usually, where you have financial innovation, where you sort of try to get away from what do we do without a lender of last resort in these offshore markets, and that very much drives financial innovation over time. And there is at least a co-occurrence between the swap lines and the FEMA facility, but particularly the swap lines, and a much lower rate of innovation in the offshore banking in terms of new tools, and this also coincides with the shadow banking part. So to answer your question, how I would like design the research the research paper would then be to see whether you have a similar effect for FEMA and shadow banking, but I don't think we see it necessarily that way.
So I'm afraid we are out of time. So I want to thank very much both Andrea Binder and Linda Goldberg for sharing their thoughts on the geopolitical management of liquidity with us today. We have one more session to go on the 29th of April, which will turn our eyes to the emerging markets that already popped up repeatedly today. So we're hoping that you will come back. Thank you again, especially to the commentators for coming and presenting, and for all others listening in and participating in the discussion. Have a wonderful afternoon or evening, and see you soon. Next time, we're all again on 6 hours difference. I'm sorry that we didn't make this clear enough in the emails. The US changed to summertime, but Europe has not yet. So anyway, have a wonderful day. Thank you again for coming.
Thank you.
Thank you. Bye-bye.
Thank you for having me.
Thank you, Linda. Thank you, Andrea. It was great. It was really wonderful.